Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at OSCR Health.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
OSCR Health, for a long time, they were sort of the classic tech disruptor story, trying to break into this really old, heavily regulated industry. But it feels like now they're actually starting to deliver on that promise. I mean, we're seeing this massive growth on the top line, but also real improvements in how they actually run the company.
That's the whole thesis right now. It's a company that's finally, successfully using its technology to be that digital-first disruptor.
Right.
And this isn't just a growth story anymore. It's about a clear path to profitable growth finally starting to become visible.
Okay, so let's start with those numbers, the ones that really show the scale here. The growth is, well, it's explosive.
It really is.
If you just look at Q1 2025 revenue, it hit $3 billion. That's up something like 42% from the year before.
And critically, that isn't just them hiking prices. They're actually bringing in new customers. Membership grew 41% year over year.
Wow.
So now they're at about 2 million members. Getting that kind of simultaneous growth in revenue and membership is, well, it's pretty rare in insurance.
And it seems like management is confident they can keep it up. Their full year 2025 revenue guidance is set between, what, $11.2 and $11.3 billion. That's a pretty strong signal that they think this momentum is sustainable.
Well, and if you step back and ask why this is happening, you get to the core of what they do. They operate mainly in the ACA marketplace, Obamacare.
Which is a tough market.
A very tough market. But they're winning because they use data analytics and tech to personalize the whole experience in a way that, frankly, the legacy insurers just can't.
So we're talking about more than just a slick app then?
Oh, absolutely. It's about building a better relationship. They use their models to guide members to the right care, to keep them on track with their plans.
And that creates loyalty.
It creates loyalty, it drives retention, which is gold in this business. But more importantly, it helps improve actual health outcomes, which, at the end of the day, lowers the cost of care. That's the loop they're trying to close.
That makes sense. The tech, the outcomes, the costs. It's all connected. Okay, let's pivot a little. Let's talk about the company's financial structure, because this is where it gets really interesting for me.
Yeah.
A company scaling this fast,
Yeah.
you'd expect them to be loaded with debt.
You would. But OSCR presents a completely different picture. The balance sheet is, it's exceptionally strong. And the headline for me is this: zero long-term debt.
Zero in health insurance.
Zero. Think about that. Their competitors are often carrying billions in bonds. This is a huge strategic advantage.
So what's the edge that gives them? What can they do that a highly leveraged competitor can't?
Well, for one, they don't have these huge interest payments dragging down their cash flow. They're not tied to debt covenants. They have, as of Q3 2025, about $4.9 billion in cash and investments.
And a lot of excess capital, right?
Right. Another $907 million in excess capital. That gives them maximum flexibility. They can invest in their own tech. They can make opportunistic acquisitions, all without having to run back to the market constantly. It's a massive competitive buffer.
And we're seeing that same kind of discipline on the operational side, too. The scale is finally creating some serious leverage.
Yes, the Q1 2025 numbers showed a real operational turnaround. We have to look at their SG&A ratio.
Selling, general, and administrative costs. Basically the cost of keeping the lights on.
Exactly. That fell to a historic low of 15.8%.
And that drop, it was significant. It was 260 basis points year over year. So for anyone listening, that's a 2.6 percentage point drop in their operational cost base, which is huge.
It's the clearest sign that their technology is working, that it's automating things and cutting down on manual work.
And that flows right to the bottom line.
It does. Operating margin improved by 110 basis points to 9.8%. And the operational earnings trajectory is it's undeniable. Q1 operational earnings went from $112 million a year ago to $297 million.
Okay, so let's recap. We have market disruption, explosive growth, a perfect balance sheet, soaring operational earnings. So if everything is so strong, what's the catch? Why is the market still a little hesitant?
This is the critical question, because despite those fantastic operational earnings, The company still reported a net loss to common shareholders in Q3 2025 of about $137.5 million.
That's a huge disconnect. How can they be so profitable in their day-to-day operations but still post a big net loss?
So the Q3 loss was mostly due to two things. One was some debt from new convertible notes, but the really big factor is something called increased risk adjustment payables.
Okay, hold on. We probably need to break that down. What exactly is a risk adjustment payable?
It's a mandatory part of the ACA. It's designed to stop insurers from only signing up healthy people. So if Oscar enrolls a group of members that turns out to be healthier than average, meaning their medical costs are lower,
Right.
they have to pay a risk adjustment fee to the government. And that money gets redistributed to other insurers who ended up with sicker, more expensive members.
So wait, you're telling me that if Oscar's tech is so good that it helps them manage care efficiently and keep their members healthy, they effectively get penalized for it?
In a way, yes. It's a non-operational regulatory cost. They're a victim of their own success, in a sense, and that's what's creating this pressure on the net income line.
And that uncertainty, that accounting pressure, that might explain some of the insider activity we've been seeing, right?
It's definitely something to watch. We saw some significant sales. A co-founder sold almost 400,000 shares back in September. Then in November, the president of technology and CTO sold a similar amount.
No, these can be just planned sales, people cashing out options.
Of course. They're often routine liquidity events. But when you see that volume from key people, you have to track it closely. Even if big institutions are still buying in, it adds a layer of complexity.
And they're also adding complexity through acquisitions, aren't they? They're trying to integrate companies like INSX Cloud and IHC's specialty benefit.
They are, which is necessary to build out their platform. But you're right, it's a huge undertaking to merge different tech platforms while also growing at 40%.
So there's a real execution risk there.
High execution risk. If those integrations don't go smoothly, you could see some of those efficiency gains we just talked about get wiped out temporarily.
Okay, so given this mix, the strong fundamentals versus these real risks, what are the charts telling us? What's the technical picture look like?
Well, technically, the stock is in a very clear bullish trend. It's trading above its 50-day and 200-day moving averages, which is, a classic sign of strength. We saw the price move up from around the $12 range to where it is now, about $16.50.
And where are the key levels investors should be watching for support and resistance?
I'd say key support is right around that $14 mark. If it holds there, the next major resistance levels are up in the $18 to $20 range. Analysts are pretty bullish, though. The consensus price target for 2025 is actually up around $31.40.
Wow. So the street sees a lot more room to run.
They do, if Oscar can hit its targets.
And hitting those targets depends on a few key events. Let's talk catalysts for the next, say, 3 months. What's first?
Number one is definitely the Q4 earnings release expected in January. Investors will be watching for two things: continued member growth and any signs that those loss ratios are stabilizing.
They need to show they have a handle on the medical costs and those risk adjustments.
Exactly. But beyond earnings, the single biggest driver here is regulatory.
The ACA subsidies.
The ACA subsidies. Any news about extending those is a direct and powerful tailwind for Oscar's entire business model. Any positive news flow there has historically sent the stock soaring.
And then there are the market mechanics. We're coming up on ETF rebalancing for the Russell and Nasdaq.
That's right, which can force huge amounts of buying or selling from index funds. And then right after that, in January, we get the 13F institutional disclosures.
Right, where we get to see what the big hedge funds and mutual funds have been doing.
Yep. The January report will show us if the big money was piling into Oscar Health during this recent run-up. A lot of new institutional buyers would be a very strong bullish signal.
Okay, and one last thing on catalysts. The tech itself. What's the key innovation to watch?
It's all about their AI-powered care guides.
Yeah.
We need to see that they're getting real traction with those. These aren't just chatbots. They're AI systems that proactively connect members with the right doctors and simplify the whole, nightmare of navigating healthcare.
So it's about cutting down on that friction.
That's it. It guides the patient down the most efficient path, which, again, brings us all the way back to lowering claims costs for Oscar.
It's a really interesting model, and it makes you wonder if there are other strategic moves on the horizon. Any speculative buzz?
There's always chatter. Given how strong their tech platform is, some think they could start selling it as a service to other health systems, a high-margin software business.
Or they could become a target themselves.
Or they could become a target. With zero debt, they're a very clean, attractive asset for a giant legacy insurer that wants to buy, not build, a modern tech stack.
Okay, so let's tie it all together. If you had to give the final summary, the big picture takeaway for someone listening, what is it?
The investment case here is built on this really rare combination. You have high growth, you have improving operational leverage, a zero debt balance sheet, and positive technicals. The company has just run so much better than it was a year
Oh,
ago.
yeah.
But you have those persistent net losses from the regulatory accounting, and you have the ongoing insider sales. You have to watch both of those things very carefully.
It really feels like a battle between their technology and the sheer complexity of healthcare finance and regulation.
That's the perfect way to frame it. I think the question for investors is whether their unique technology edge can close that gap, the one between huge revenue growth and actual net profitability, faster than their competitors can adapt, and of course, before the political winds change.
A huge story to track. Make sure you subscribe to Smart Wealth with Joshua to continue following this one and other stocks. We'll see you next time.
Subscribe now.